Prices impose the most effective kind of rationing, self-rationing. Why is rationing necessary? Because what everybody wants always adds up to more than there is. Resources are limited, but desires are not. That is the basic and defining problem of economics.
Retailer. Like, instead of holding my money at a bank, I could hold it as a stablecoin. Let's say I'm doing payouts to Dashers or Uber drivers or whatever, and they've got a wallet and a balance. Why wouldn't I hold that wallet as a stablecoin where I collect the yield instead of the bank collecting the yield on that? So that, I think there's a real risk of deposit flight that they're right to be concerned about. But the flip side of that is, well, you can compete in other ways as well. You can wrap things around the token that you do just as you do today. A financial institution does more than be a wallet. It wraps financial products together with its balance sheet. It's able to be competitive for its biggest customers in a way that I don't think it had been historically for some of its smaller customers, which is, all right, you've got your checking account with us, so we'll give you this better mortgage rate. Like that type of, you did one thing, so you do the other thing, is what a balance sheet allows you to be able to do. And I guess it sort of looks like collateralized lending, but an even better deal because they can take the risk on some of that stuff because they have a license to print money. They can create net new deposits. And so that, again, I still think of the competitive advantage of a bank as they've got a balance sheet and they've got a license to create deposits. That, to me, is something that they could go use and go weaponize. Like, why not? Go compete. And expect that the innovators in the crypto community and the stablecoin world is going to innovate like heck, and they're going to do some incredible things too.
The money supply is created by the banking system. The banks give out loans, and then the borrower pays back the money plus interest. This is how money is created. Stablecoin providers and banks are going to have very different rules and regulations. You see, the banks are going to continue to be able to leverage all of their assets on their balance sheet. So this is why different banks are offering products that are all tokenized futures, tokenized equities, tokenized real estate, tokenized everything, because they're trying to attract stable coins onto their platform because these are assets that they can lever and use for their own gains.
There's been an increase in crypto scams, and scams including deepfake AIs that use somebody of importance advertising to send money to a certain crypto address. Police are dismantling fraud rings, but this isn't stopping scam artists. NordVPN is a sponsor of this show. Nord is not just a VPN, they also have Threat Protection Pro. And recently they added a crypto address verifier. When you use NordVPN, there is Threat Protection Pro that's running in the background, scanning websites and looking out for malware. And it flags malware and lets you know if something's unsafe to click. But now they've also added in crypto addresses to make sure that you're not sending funds to an unsafe address. With just one click, you can make your computer safer. And Nord utilizes resources very efficiently, so it's very lightweight. Get an exclusive NordVPN deal. This is 4 extra months when you use my link, nordvpn.com/Darren. It's risk-free, and there's a 30-day money-back guarantee. So check them out at nordvpn.com/Darren.
Industry insiders I have spoken with have said that eventually you will see the entire financial market run on blockchain. You started to see this with stable coins, and then now we're starting to see it with equities. We've heard of the announcements of Robinhood introducing 200 US tokenized stocks in the EU. Gemini also offering tokenized stocks in the EU. Those are more derivative products that are not available in the US. But you've had the NASDAQ that has asked the SEC for permission to be able to offer tokenized shares, tokenized tokenized securities on the NASDAQ. And that's because of this wave of the entire financial infrastructure, which is expected to upgrade to blockchain. And they don't want to lose ground to platforms like Coinbase, like Kraken, like Gemini. This is a big market. Just to show you what one study shows is that real world assets, the market cap for real world assets is expected to go from 600 billion this year to about 19 trillion in 2033. And we're not just talking about equities. We're also, of course, talking about bonds, gold, real estate, any type of real world asset that you can think of. Now, why would you want tokenized equities? What is the benefit of them? Well, they can be more easily traded. There's faster settlement times. They can be split into smaller pieces, so you have more investors that are able to access these. They can be accessed from anywhere in the world, and they can also be used as collateral. I mean, I had one industry insider telling me you'll be able to even swap. Let's say you want to dump Alphabet and buy Tesla. You'll be able to do that in one move. You won't have to sell one, wait for the settlement, and then buy the other one. The goal is to eventually have stocks like Tesla, like Amazon, like the Mag 7, all issuing, those companies issuing their shares on blockchain. The challenges, of course, are that you have settlement processes that have to be changed, clearing processes that have to be changed. These are processes that can take days as far as settlement time. So all of that needs to be shifted, to be changed, and that is going to take some time. But this is definitely revolutionary as far as the financial market's concerned. In the end, everything is going to migrate. That is what Wall Street is betting on.
Imagine a tokenized world where everything that you own has a token associated with it and some form of liquidity. So this includes your investing assets like equities, crypto, real estate, but also includes things like your car title or your computer's resources. Every single thing that you own can be liquidated, and therefore your entire net worth can be used as a form of collateral and then pushed into markets to add even more value. This is what banks do. They borrow against different assets and take advantage of opportunities. But in a tokenized world, this can go down to the individual level. And with AI and agentic payments, we're going to see AI automate a lot of these processes where the individual doesn't necessarily know what assets are being levered and where they're being invested. We're already seeing distortions in the markets from REITs or ETFs or any of these passive investment strategies, and it's just going to get worse.
So lots going on, and it's not just in the US. As you will hear through the course of this webinar, as my colleagues Chang-Will Young, Nathan Chow, and Samuel Say will present, that the ripples from the US are hitting particularly the shores of Asia in a very profound manner, and lots of things are happening in China and in Hong Kong. So it's an exciting time, and doesn't mean that it's only an unambiguously positive story. We might be moving too fast in certain areas. There are some questions on regulation, but there are even more profound questions of the nature of money and monetary policy transmission and the ubiquity of these assets in a fiat-based system. Something might have to give. We'll see whether this cheerleading by the U.S. lead to fundamental structural improvements in the safety, security, and governance of the crypto ecosystem, or it actually leads to a worsening. Time will tell, but let's just, MAS has sort of gone with the BIS guidelines and have been fairly cautious about the digital ecosystem. There are numerous sandboxes, some of which even DBS participates in, particularly on the trade finance blockchain utility called Partior. But on stablecoins, no major announcement or anything for the time being. But given the ripples around the world, I mean, what's this space? Sooner or later, we'll hear something.
There is actually a Sing dollar stablecoin, but it's not widely used. It's called XSGD.
This was a podcast on DBS's channel, and they spoke and hinted at the partnership with Ripple and Franklin Templeton We have seen similar announcements by Ripple, and the name of the game is repo markets, and this is to borrow money overnight between different institutions, so repurchase agreements. Economy and Guggenheim were other examples of this markets for commercial paper. Now, the host warns that we may be moving too quick and we don't understand the implications that these technologies have. There is a misallocation of resources happening where businesses are investing in AI and computation rather than in people. You were taught in school about the trickle-down theory, and that was probably a lie, but it's even a bigger lie when companies are investing in artificial intelligence, robotics, and they're no longer investing in human resources, leaving the wealth gap to widen even more.
The DBS digital asset ecosystem is a secure, integrated, transparent, and reliable platform to access selected cryptocurrencies, as well as a platform to invest in tokenized security assets within a regulated environment. Institutional and accredited investors get access to banking services, trading, digital exchange settlement, and digital custody, all under one roof. With the DBS Digital Exchange, digital assets such as cryptocurrencies can be traded 24/7. The digital exchange allows institutional and accredited investors to enjoy low frictional trading, access to private market opportunities, and market liquidity. Tokenization of real assets, like shares in unlisted companies, bonds, funds, and real estate assets, can also be traded. For investors' protection, cash deposits and digital assets are safe kept with the bank, and customers are the beneficial owner of their assets.
Have you seen my previous videos with Larry Fink? He talks about the opportunity of private credit, private equity, infrastructure. The reason he talks about these different opportunities is because the governments are constrained by the amount of inflation that they can create. So instead of the government printing money, they're going to have the private sector invest in the things that normally the government would invest in. Keep in mind, everything that is in the DBS system is an asset for DBS to lever.
If you don't start from the political reality that the modern nation state charters banks and regulates them for its political purposes, you're never going to get really very far in understanding how banking systems evolve. Because banking systems don't evolve through some sort of automatic process. They evolve under the restrictions and under the opportunities that are provided by the nation state. That can be an opportunity if the nation state charters a bank like the Bank of England, whose sole mission when it was chartered was to help organize the finances of the state so that it could fight France. That was the point of chartering the Bank of England. It wasn't so you, Ryan, could do something that you wanted to do. And by the way, that bank was given a monopoly in England and Wales over note creation, that is, printing money. And so that wasn't a coincidence either. That was part of the partnership between the people who operated the bank and the sovereign. There's no way to understand the history of banking in England without taking into account that banks weren't allowed to exist in effect, except as small private entities, very small. They were restricted in their size if they weren't the one the state chartered. So a bank, yes, okay, we can now talk about all the functions that banks may or may not do, depending on what the sovereign allows. And we can also talk about shadow banks, the banks that aren't chartered by the sovereign, which just do any kind of financial transactions that they can get away with if they're not prohibited. But we don't start off, if you start off talking about banks as some kind of natural, abstract idea, you've really missed the boat. In the modern era, banks are either, and this is the most important one, chartered entities of the state or things that operate in the shadow if they can get away with it and aren't prohibited by the state.
Peer-to-peer lending, decentralized finance, stable coins, all of these great use cases give individuals freedom and power. But the reality is that the only reason this is happening is because the banks have an angle. Banks are above the law. They're too big to fail. If anything were to happen to them, they get the taxpayer to bail them out. There's an incestuous relationship between the government and the banking system, and this is not by accident, it is by design.
Explores the use of blockchain technology to create purpose-bound money, or money programmed for designated use. It all starts with making money more efficient. With our tokenization capabilities, traditional currency can be minted as digital money. Once it's all digital, we then wrap it with a set of programming logic, or smart contracts. This means you can be specific about whom it can be used by, when it needs to be used by, where it can be used, even down to what it can be used on, and more. Only when all these conditions are fulfilled can the token be unwrapped for use. We have partnered Open Government Products to launch a live pilot on the Redeem SG system.
This is a DBS project with the Bank of International Settlements called Project Orchard. And the idea behind it is programmable money, or different vouchers that the government gives its citizens, and it could be spent like money. If you go to the redeem.gov.sg site, there are vouchers for keeping a low carbon footprint to use less energy, and you need a digital identity in order to claim the vouchers, and these vouchers can be spent in certain supermarkets and grocery stores. Now, MasterCard is doing something very similar, where they have points that people accumulate for using less energy or spending it on social goods, and they're given points that add up over time.
And doing so, we're working with a number of different partners, with Ripple, DBS, different companies around the world, to say, well, how can you help this whole transaction go from front to back? We've set up all the networks, we're ready to go, but the activity is beginning to come about slowly, right? Where people are actually holding it. Initially, the people who bought cryptos, they thought it was going to grow 10x or 20x or 100x, whatever the case may be. But now they're really thinking about using those funds for transactions because they are easier, right? If I can travel to another country and use my digital assets to make a payment instead of having to convert, local funds at the bank, at the airport, it's much easier for me. It makes it seamless. And what we're doing is that facilitating those transactions. The ability for the fact that you've got 50 million merchants on a global level, which will accept a MasterCard. We're just kind of plugging into that and saying, well, go ahead and use it. Doesn't matter what kind of currency you have. Either, you have fiat currency, you have a digital asset, you have CBDC, NFT, whatever the underlying currency that you have, we'll be able to facilitate that for you. Right.
MasterCard announced at a DBS conference that they were working with Ripple as well as DBS in order to provide fungibility. And this is the idea that your NFTs, your crypto assets, tokenized equities, tokenized real estate can be exchanged for goods and services.
And that can be around central bank digital currencies. It can be around NFTs. We actually believe and put a lot of faith behind this World Economic Forum report that says that just a huge percent, 10% of the world's GDP could be tokenized by 2027 in some form or another. And if you really believe that and can get behind what that means, that's pretty exciting. And we think that that these topics we're discussing today enable us all, and really all people on this spectrum of folks that we deal with on RippleNet, from financial institutions to edgy fintechs, are all moving in one direction.
The financial infrastructure is being created. Repo markets, partnerships, institutional DeFi. These are not buzzwords. They're collaborations between big banks, fintech providers, technology companies, and they all have a plan to digitize and tokenize all forms of value, to make value seamless and to make it universal.
Be a good thing coming out of the Besant Treasury, and to create some competition. I think that's one way to react to too big to fail and to GSIPs. The financial institutions, quite rightly in my view, would say, well, we could compete more fairly if we weren't under these massive capital controls that came out of Dodd-Frank, and we could potentially offer more yield. So we've got one arm tied behind our back. I don't know who's right in that conversation, but it certainly feels like the risk of going too much towards narrow banking is everything's private credit, and there's less obvious protections when it all does go wrong. What happens when there is a great financial crisis and the economy's on its knees? Do we just let it run? Do we just let it all burn to the ground, or do we want somebody to step in? I think that's an interesting governance question for nation states to start to think about, because if history's taught us anything, it's like, no, we quite like it when mom and dad step in and like stop the bleeding. That would be really nice. So let's see.
The economy is supposed to be a system of rewards and punishments. So if you use your capital wisely, you're rewarded by appreciating assets. And if you don't use your capital wisely, your assets depreciate, and it's a system of rewards. So when AI and tokenization is pushing earnings sky high and we're seeing all this mania in the market, we have no idea if this is the proper allocation of resources. It's estimated that electricity bills are twice as much money because of the amount of energy technology is using. So how do we know that these resources are being used properly, or if we're just mismanaging and misallocating resources? The last time we had a crisis, they went direct to the citizens in the form of stimulus checks. The next type of financial crisis will be the same playbook. And since the banks own all the financial infrastructure, they'll benefit from printed airdropped money. Nations crumble from within when their citizenry asks of government those things which the citizenry might better provide for itself. Thanks everyone, I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon.